TheoTrade. This is Don Kaufman. September 23rd, 2020. Minutes to go to the closing bell, and it could not come soon enough because the sell-side activity into this cash close is heated. S&P is down about 2.3%. Leading the pack is the Nasdaq. Russell right behind it with almost, again, a 3% loss. Let's step back and kind of break down some of the trade that we're seeing. But again, more appropriately, is volatility really starting to move? Okay, did we actually check some of the boxes that we talked about on Monday? If you don't remember that, well, I'm going to refresh your memory from back on the Monday evening video when we talked about specific levels, like in the S&Ps of 3211, which were, again, a hop, skip, and a jump just north of 3211. All right, let's get down to it here again with 2 minutes left to trade. What I want to start with this evening is the SPX. And the reason I want to bring up the SPX, it has everything to do with expected move. Because as of right now, this is the trade that you have to understand, because this is the trade that is going to drive order flow to literally everything that you're seeing on the screen. I'm going to zoom out into a daily chart, okay, and just take a quick glance at the SPX. Now, for those of you that understand here, kind of in context, this is the SPX expected move. This is the upper edge of the expected move and the lower edge of the expected move. Now, this week, okay, we had stated that the expected move was about $83. That means we're supposed to move $83 higher and or $83 lower. All right, we actually achieved literally that to a T. Now, when we start talking about expected move, you know, people think it's like this fictitious beast that just lives out there. No. The expected move is the order flow. Like, where does that $83, where does that even come from? What that basically is, when you look at the $83, that is literally billions of dollars that are being traded, both on the buy side and the sell side, that ultimately derive, okay, that expected move. And as such, okay, when we hit the upper and or lower edge of the expected move, you'll actually see the market drawn to it. And that's hedging activity that's doing so. And take a look at the edge of the expected move today. Now, again, this is a line that we draw on the screen, the previous Friday. This is something that if you went back and listened to the TheoTrade, weekend update from, again, last Friday, we'll talk about this $83 move. And more specifically, we said, don't sell options this week because we felt that the move was, extremely small. $83, I mean, come on. It's basically what we're doing today. The entire expected move is wrapped up in here. Now, why is this so important? Well, first and foremost, there's the closing bell. We already hit the edge of the expected move on Monday. We bounced, literally, okay? Monday, we were down 83 points. We bounced 83 points. Now, we're back down 83 points. I mean, it's an absolute roller coaster of a week. I mean, that's an understatement. But again, we're holding the edge of the expected move, okay, for now. Now, before I go any further and do any analysis about volatility, okay, why this is so important. Well, we've actually displayed recently, okay, several mild breaches of the expected move. Now, that was at week's end. The big question mark here is you're at the lower edge of that expected move already, and I'll zoom this back in to give you guys a little bit of a better feel. But you're already at that lower edge of the expected move. And at this point in time, okay, it's always fair to say that the highest probability for trade is that you're going to end up inside of what was expected. And that's anything north, okay, of 32.36. Quite ironically, that's exactly where the marketplace closed. But 32.36 is the edge of the expected move. The highest probability is right now, we're actually going to close above that and obviously below here, which is about 3,400. That's the higher probability trade. However, anytime you're sitting and you're like halfway through a week and we've already come this far, there is a lower probability, but still quite substantial, of what we term a significant, breach. And that could be as much as like a 2 or even 3 sigma breach. The reason that I bring this to your attention. The market behavior as of late, okay, has been relatively efficient. Relatively speaking, all right, when I say efficient, if you look back at some of the recent weeks here, right, this is inside the expected move. Inside, 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 all right? That's such a mild breach doesn't count. This is inside, inside, okay? Here, we have a breach of the expected move. The next week, a breach of the expected move, okay? The previous week, inside. These two breaches might just be enough. One of the things that we have found through a tremendous amount of research is when you start seeing sequential breaches of expected move, okay, that it's very likely to continue to see those breaches. So even though I'm telling you, the higher probability trade is to be inside the expected move. Yeah, but on the flip side, okay, those two breaches, you should be afraid at this point. You should be very afraid because a breach, okay, here would mean that the marketplace is starting to crack apart again. And maybe that's what it's going to take to actually find, some degree of a bottom inside of this marketplace. But we were incredibly efficient in this period of time, right up until the point we actually broke to the upside. Now, again, a lot of research went into giving you that statement. That is, when the market starts to display greater degrees of inefficiency, it continues. And, there's a great way to explain this, and actually look at like the Corona crash. Okay, I'm going to go ahead and close up that left side bar. You look at the Corona crash. And, okay, this is the marketplace chugging to the upside in January, but it was already displaying degrees of inefficiency to the upside. This one's to the downside. This one's to the downside. This is to the upside. What I'm telling you, look, that one's actually a mild breach. What I was telling you is almost every week prior to the Corona crash, we were already displaying high degrees, very high degrees of inefficiency. This just snapped, okay? And yeah, you're like, but listen, the market didn't necessarily see Corona coming, but it saw, okay, that efficiency trade start to break down. What I can't answer for you right now are those two breaches enough to get us actually rocking to the outside? All right, my opinion, yeah. Listen, if we're going to breach the expected move this week, right? Again, strictly my opinion, it's going to be ugly. You're looking at a 2 or 3 sigma move. And given the fact that we still have Thursday and Friday, we have some problems. Now I'm going to show you one other very substantial problem with the marketplace right here, right where we're at. And then we'll start to talk about some levels, okay? On the week, the SPX is already at the lower edge of the expected move. But here's the real problem, right? We come up and we actually look at none other than the QQQ. And the QQQ, I'm going to apply auto expected moves. With the QQQ and its auto expected moves, what do you see? Okay, what do you see here? Well, this is in huge contrast. The problem that you have this week is you would have anticipated with the marketplace selling off, okay, but the Nasdaq would have actually led the sell side activity because these are the stocks, of course, that are, well, getting hit extraordinarily hard. The monsters of tech are down 3.5% today. The monsters of tech exceeded the loss of both the Nasdaq and the S&Ps. Yeah, but what you're missing is they've been outperforming throughout the course of this week. Why I think that this is fairly dire. For the monsters of tech to even get to the edge of their expected move, or for the Nasdaq, if you will, to get to the edge of the expected move, that's going to take the S&Ps apart. It's just absolutely going to take the S&Ps apart. So what I'm telling you here, again, there's a higher probability that we close inside the expected move. Yeah. However, if there's continued sell side in tech, it's going to decimate the S&Ps, and then we're going to accelerate to the downside. Now, with that, let's back away from some of the levels. Again, the most important understanding here is that the QQQ is actually performing really, really well this week relative to the S&P. And the great way to look at that is to look like, here's what the Qs were expected to move. All right, and then you look at something like the spiders, and here's what the spiders were expected to move, and the spiders are actually right on the edge of that expected move, but the Qs, they're outperforming. If you're curious where the IWM fits in here, the IWM, it's having some issues, people. Okay, the IWM is a full standard deviation outside its expected move. This is not what you would have anticipated. Again, you would have anticipated if this marketplace would have come apart at the seams, that it probably would have been done on the back of the Nasdaq, and that hasn't been the case, which again leads me to believe that, yeah, unfortunately, the sell side hasn't really, it hasn't hit kind of, its stride inside of the QQQ. And I could probably further that by arguing that even volume today inside of the Nasdaq, it wasn't exactly like stellar. All we did is just, throughout the course of the day, yeah, some sell side activity kind of heated up a little bit here, but net kind of drifted, if you will, a bit lower. You can see, again, volume even in the Nasdaq futures not too extreme. All right, let's spin things around for a second. Before I go any further here, okay, there's an expectation and something that I said on Monday night that, again, I want to reiterate, and that is we have a gravity point. It's the first time that we've really been discussing gravity points, okay? It feels like forever. And this gravity point here happens to be none other than 3211. As I said on Monday, and I'll say it again here on Wednesday, we need to check that box, okay? That's a box that's got to get checked. We got to come down. We got to dance on 3211. Now from there, I'll reassess. Okay, and again, we're only a hop, skip, and a jump away from 3211 inside of the S&Ps, right? But from there, I have to reassess because at that point, gravity points are neither support nor resistance, okay? They're just what I said, gravity. Will actually be drawn to that particular level. I would not be surprised to see the markets this evening drift right into the 3211 and then literally skirt that line throughout the course of the evening. Again, wouldn't be surprised at all by it. But that's the first level that I think you have to consider. Thereafter, I don't have any great levels until we get all the way down to like 2983, 2911, 2842. We'll worry about that then, okay? The 3211, though, is a big step along the way. Now, another aspect that's still, okay, on my mind and, sitting large out there, it's volatility. It continues to be the story here. We've all seen the sell side activity. As I said, it's heating up over here, but like volatility is like, you haven't seen anything yet. Okay. Again, I'm inclined to believe that the volatility was so extreme, so hostile back in that time frame of March. Okay, when you start zooming in to the 85 candle over there. But again, I'm led to believe that this was so large and so hostile that markets do in fact have memory. And it remembers, I'll say this as pleasantly as possible, all hell breaking loose back here. So right now, we're slipping to the downside, but we ain't home yet. And again, I'm left with the belief and left with the understanding, okay, that we're not home yet. And by home, I mean, listen, the market is absolutely throwing off some bearish connotations. And whether you're picking up on that, some people are going to rush back into this marketplace and look at it as a buying opportunity. Okay, I'm taking the other side of it. Every time we bounce, I've been selling into it. Every time we bounce, I've been selling into it, right? We bounce, we short. We bounce, we use an in-out spread. Now, I'm defining my risk, okay? But it is open season right now to the downside. And people, we are well positioned. When you have an account, and I'll tell you what, I traded a little bit today. 12 orders, 12 fills, up almost $20,000 though in the day. Everything is firing the way we would anticipate. The only thing that isn't playing out, okay, like we'd like to see, is that the Nasdaq shouldn't just be, selling off more. That the Nasdaq should actually be leading the sell side activity. Again, volatility, lackluster. Even when you start looking at things like the VVIX, right? The volatility index, it's not even above 110. Again, the big question here, when, okay, does the sell side activity catch its stride to the point that it rocks the VIX to the upside, right? Because until you start to see that, degrees of higher volatility, until you really start to see higher volatility, we just haven't felt that fear. Until you feel the fear, you can't have a bottom. Again, you look at this and a day like this and looking at the volatility, you would think that this is a kind of a mellow trading session. Yeah, mellow trading session where the S&Ps are down 2.2%. Huge amount to think about. Again, we hit that 32.11 overnight. I will be reevaluating live on TheoTrade first thing in the morning. Again, 32.11 is a key inflection point in this marketplace, and we'll take it from there. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye bye.